Welcome to Module 3 Part 2. This is more on gross income. And most of what we're going to cover in this chapter is related to exclusions. So let's recall, gross income is income from all source, from whatever source derived, unless it was excluded or deferred. And this chapter is all about excluded. So exclusions tend to read like a menu. And here's a list from a book that's not the book we're using that describes a number of the things that are excluded from gross income. Makes sense to take a look. A couple of these things we've covered. Municipal bond interest we've talked about. Olympic medals we've talked about. I think that's it. Okay. So gifts and inheritances are not part of gross income. Those are excludable. So when you receive a gift, that is excludable. But you have to be able to separate a gift from a taxable transfer, which means that disinterested generosity is generally required. So what that means is payments from an employer to an employee are generally not disinterested generosity, right? It's very difficult to break that down. But sometimes if it's a related person, so if the boss is, the dad and the child is a son, sometimes you can get gift treatment for things because you could claim there's a disinterested generosity there. Otherwise, it's extremely difficult to get that. Life insurance proceeds. So when you receive the proceeds from a life insurance policy upon someone's death, those are excluded from the beneficiary's income. That is not includable. However, this does not apply when a policy is purchased for consideration. So if A purchases a life insurance policy on B from C, and A pays $20,000 for the $100,000 policy, and then subsequently pays $10,000 in premiums on the policy before B dies, and then the policy pays, A's taxable income is the $100,000 minus the $20,000 they paid minus the $10,000 in additional premiums they paid, or $70,000, right? So when you are purchasing a policy for consideration, that undoes the non-taxability of life insurance benefits. So life insurance policy can also be surrendered, which means you give back the policy and, of course, any benefits that were associated with that policy in exchange for whatever the cash surrender value is of the policy. So if the cash surrender value is greater than the premiums, then that creates income. If, on the other hand, the cash surrender value is less than the premiums paid in, then there's nothing. You don't get to claim a loss. So, yeah. So awards are taxable unless excluded. There's an exception for Nobel Prize, as long as the winner didn't enter themselves. There's no future services required. And they're required to designate that the payment be made directly to a charitable organization. A couple years ago, they passed a rule that said you could exclude the value of any cash or prizes awarded by the United States Olympic Committee, unless the recipient's AGI exceeds $1 million. So I call that the Michael Phelps rule. That guy's income generally does exceed $1 million, and so when he won his 20 whatever medal, his cash and prizes were includable in his income. Scholarships, as long as they are used for qualified tuition and related expenses, those are not taxable. So qualified tuition and related expenses are things like tuition, fees, books, supplies, and any required equipment. Does not apply to room and board. Withdrawals from 529 plans are what they call qualified tuition plans. You make contributions, so this is another classic lockbox.
An ironclad lockbox
arrangement where you pay money in, and as long as you pull it out and use it for qualified educational expenses, any income that the plan has generated is not taxable. So the idea is you can save just in a savings account, or you can put that money in a 529, and therefore its income is not taxed as long as it's used for qualified educational expenses. And starting with the Tax Cuts and Job Act, you can also use it for up to $10,000 on K through 12 tuition. So that's tuition only, not any other expenses. So when you receive payments for physical injury, those are also exempt. So if you were hurt in an accident and your leg was broken or whatever, and you sued and you received a payment that was meant to cover your physical injury, that is in fact exempt. And that doesn't necessarily mean the amount that you spent on medical expenses. It truly means the amount that the settlement attributes to physical injury. Generally not for mental anguish unless the mental anguish stems from the physical injury itself. All right, so as we talked about with gifts, payments from an employer to an employee are almost always gross income. And that's true whether they're paid a salary, wages, bonus, in kind, such as property or services. So an in-kind payment would be, instead of giving you cash, I give you sneakers, right? If I work for Nike and I give you 1,000 pair of sneakers, that's just providing you property, but that's an in-kind payment, and sure enough is generally still taxable. However, there are a few things such as healthcare insurance, life insurance up to a certain amount, disability premiums. These can all be excluded from the employee's income, but still be deducted by the employer, and that's done for policy reasons, right? Because it's a good thing if people have health insurance and life insurance and disability insurance. And then there are a few other benefits that are excluded but remain deductible for the employer for administrative reasons, things like de minimis fringe benefits and working condition fringe benefits. So the general rule is that fringe benefits are taxable, but qualified fringe benefits are excludable. And some of the things we just mentioned are in fact qualified fringe benefits. So the biggie is employer paid insurance, and that covers health, accident, and disability. All of these are excluded. Life insurance is partially excluded if it's group term life. So you can have, your employer can purchase for you up to $50,000 of group term life insurance. They pay the premiums on your behalf, and that is not income to you. It's only when the insurance amount is greater than $50,000 that there is, in theory, a taxable benefit. And when that happens, the IRS provides tables for the employer to calculate the amount of income that is associated with that benefit. So if you recall back in the part 1 of Module 3, we talked about compensation for Steve, who was an employee of the state of California. He had exactly $50,000 of group term life insurance, because that's the maximum amount you can have and not be taxed on it. Okay, there are tons of others. The book does a fairly good job of describing these, but let's go through them anyway. So there's something called a no additional cost fringe. So the classic example is the airlines allowing their employees, the employee spouses or dependents, and retired employees to fly free, but only when an empty seat is available, because that's at no additional cost to the airline. I guess the idea is that additional weight really counts for nothing. And I actually think these days the employee actually has to pay for the taxes. So it only works with a specific line of business that employee was part of. So for example, a free hotel room to an airline employee doesn't work. So similar to a no additional cost fringe is an employee discount. So if that employee discount is qualified, it is not considered taxable to the employee that receives it. So if the employee receives a discount on goods, they need to be sold to the employee at a price that is at least break even or more. So if the employee works at Best Buy and they have their eye on the Maroon 5 Super Bowl live show CD, and Best Buy buys it for $2, but it retails for $17, the employee can in fact buy it for $2, which would be the employee discount down to its cost. So Best Buy would break even on it, and there'd be no taxable income to the employee. If it's services, then the discount that is permitted against the regular customer price can be no more than 20%. So if you give someone a 21% discount on services, that's going to be a taxable discount as opposed to non-tax. So let's say that secretary, an administrative assistant, I should say, works at a law firm, and she's getting divorced, and the lawyers decide that they'll provide divorce law services at a discount. If they do it at no more than 20%, then that discount's not taxable. Anything above those limits is taxable. So the taxable income part doesn't kick into 100% if it's more than 20%, or all of it if it's sold at more than break even. It's just the amount in excess of those thresholds. So working condition fringes are items where an employer pays for what would have been deductible by the employee anyway. And so we usually think of these as professional dues, things like magazines that are, trade or business associated with what the employee does. These are all working condition fringes. So if, for example, you were a stockbroker and your employer paid for your subscription to the Wall Street Journal, that would probably be a working condition fringe. Whereas if you were a stockbroker and your employee paid for your golf magazine, that has a much lower chance of being a working condition fringe. And then there are things called de minimis fringe benefits, and these are ones where it's not administratively feasible to track by employee. So things like providing free coffee at the office or the occasional personal use of an office copy machine. There are a number of companies that provide eating facilities on property for their employees, and those are not gross income, but those are now limited to only 50% deductible, and then that deduction is going to go to 0% in 2026. So if Google provides a subsidized cafeteria for its employees, that is the costs of that facility are considered a de minimis value to the employee and therefore not includable in their income, but they're now only 50% deductible by Google. Qualified transportation fringes, so things like commuter vehicle use, which is carpooling, a transit pass, not real popular in San Diego, but for those that take the trolley it would be, and parking. So this means that the employer can provide the employee with either a transit pass or parking or the use of a carpooling vehicle for up to $260 a month, and that is not taxable to the employee. However, that is now non-deductible by the employer. Just to be safe, there are programs that employers run where you can have employees purchase their own transit passes or parking with pre-tax dollars. That remains a completely acceptable fringe benefit. The idea is it's just excluded from your pre-tax dollars, but it's not as if the company gets a deduction for it because it's not their money. So, for example, again, going back to the Steve employee of California, he was paying for parking, and that parking was kept out of his pre-tax income. It was a reduction of his pre-tax income. Okay. So, recreation and athletic facilities, this was a close call. It was just about on the chopping block in the last tax law, but it survived. The value of providing a gym for your employees on site, that remains excludable to the employees. The book says that it's not deductible, but that's simply not true. I'm thinking the timing was wrong because that does in fact remain deductible. It's only non-deductible if it's only for highly compensated employees. So, for example, if you have to be officer of the company in order to get access to the gym, then that is in fact a non-deductible cost. Okay, another form of fringe benefit is an educational reimbursement, and these come in all sorts of forms. We're going to start with the most advantageous version and then kind of work our way down. So an employer can run what's called an education assistance plan, or an EAP, and they must have a plan document, so it must be a documented plan that's in place and available to all employees. And up to $5,250 of payments for that employee's education can be excluded from that employee's income. So they could pay your college tuition on your behalf up to $5,250 per year, and that would not be includable. But those payments must meet what's known as the business deduction requirement, and we will get to that when we do deductions. But for now, know that the employer would make that call and decide whether that was the education met the business deduction requirement, and if so, they can exclude up to $5,250. So employee training. So if an employer pays for employee training, that is generally speaking deductible and not includable on the part of the employee. It must be required by the employee or law, but it cannot be the minimum requirement to get the job. So for example, in order to be a physician, you probably need to get a medical degree. The process of getting that medical degree is to meet the minimum requirements and therefore is not an employee training fringe benefit that would be excludable by the employee. If, on the other hand, that same physician has to get recertified every 2 years or 3 years or get continuing education, that would. So that would be to maintain or improve existing skills, not to develop new ones. So there was a case called Kaipagora that was maybe 4 or 5 years ago. It had opened up a massive hole that allowed business persons pursuing an MBA to deduct the costs of that MBA if it was paid for by the employer. But that was repealed after 2017, so that thing is dead. All right, employee awards. Remember, most payments from an employer to an employer are taxable. We talked about these awards briefly in part 1. That says, think about it. If an employer gives you an award for something, that's generally taxable income to you because it's not of a disinterested generosity. But there are exceptions for 2 types of awards: length of service and safety achievement. So length of service is no more than once every 5 years after 5 years. And safety achievement is for when you have a program that says, look, we've had this many work days without an accident. The maximum is up to $400 per employee. It needs to be paid, not in the form of cash. If it's subject to a qualified program, then the average cost is limited to $400, but an individual award can go as high as $1,600 to a single individual. These awards may never be in cash or some other cash equivalent. The second they are just another form of taxable compensation. Meals and lodging at the convenience of the employer is another fringe benefit. So I usually think of this as being the building supervisor. So let's say I had a 20-story apartment building. I, of course, need a super to work that building. So I provide that super with free lodging on premises as a condition of the employment because, of course, they need to live in the building so they can be on call to fix everything when it breaks. Meals, kind of the same thing. I usually think of the oil drilling platform out in the middle of Gulf of Mexico. Clearly, for the convenience of the employer to have those employees who are working on the rig have their meals on the rig. It's unreasonable to think they would get on the helicopter or fly back to the mainland, get lunch, then get back on the helicopter and fly back out to the rig. There just needs to be a significant non-compensatory reason for having these meals and lodging provided, and these examples I just walked through certainly, I think, provide examples of how that necessity would be good business and necessary for the employer to have it that way. Flexible spending accounts. We again spoke about these when we talked about Steve and his. You can set aside money. Again, this feels like another lockbox.
An ironclad lockbox.
Type of scenario where you put money into the lockbox.
An ironclad lockbox.
And as long as you spend it for health in one account, a health savings account, or dependent care for a dependent care flexible spending account, then you can set aside pre-tax money for those. So they're not included in my pay as an employee, and they're never included as long as I spend them for those 2 things. There are limits: $5,000 for dependent care and $2,650 for health care costs. So generally speaking, non-discrimination is a cornerstone of all these qualified fringe benefits. So what that means is you have to offer them in a non-discriminatory way to all your employees. However, no additional costs. So the airline seats, employee discounts, de minimis, except for subsidized eating facilities and working condition fringes. These can actually all be discriminatory. So you can give those, for example, only to a certain segment of your employees, and they still remain a qualified fringe benefit. Okay, another massive non or excluded amount of gross income is something called the foreign income exclusion. So this relates to a U.S. resident who works overseas. And as a function of that work overseas, they can exclude income up to, in 2018, $103,900. So that means if you take an assignment, let's say you go to work for, I don't know, PwC, and you take an assignment overseas to work in London, and you're paid in London, and your pay is $70,000. The London's going to tax you on that, but in the U.S. you can exclude all $70,000. So you wouldn't even need to worry about treaty provisions, which would probably prevent including both anyway. Of course, if you exclude the income, you cannot take the foreign tax credit associated with that income. And when we get to credits, you'll see how that works. But suffice to say, that would be double counting the benefit. You have to be a bona fide resident of a foreign country for a year, or at least 330 days overseas in the previous 12 consecutive months. And then once you click either of those, then you prorate income based on the number of days in the tax year. And we'll almost certainly do an example of this in class because it can be a little bit confusing. Okay, forgiveness of debt income. Obviously, you are better off if someone forgives your debt. As a result, that represents income. So, for example, let's say that you have credit card debt and your credit card company forgives your credit card debt because they're tired of chasing you down for the $100 that you owe on your credit card. That is income to you, and they're going to send you I believe it's called a 1099-C. It might be a CID, cancellation of debt. In any event, maybe COD. There are exceptions to this. One is if you are insolvent. So if you are insolvent, then you do not have to include that forgiveness of debt income in your taxable income. If you are under bankruptcy, if it is a student loan, when it's tied to services. So for example, sometimes you can get a student loan that says as long as you agree to, for example, be a doctor in this rural area, and suddenly you are foreclosed on that loan because you were unable to provide those services. And then the second reason that was passed in Tax Cuts and Job Act of 2017 is if you die. So if you have a student loan and you die, your estate does not need to include the amount of the loan in your income. Okay. So another thing, I'm not sure why it's stuck in this chapter, but I guess it is the exclusion on the sale of small business stock. If you sell something called Section 1202 stock, you actually can exclude 100% of the gain. So it must qualify as 1202 stock, which means it was a C Corp with assets of not more than $50 million. 80% of the activities must be used in some form of active business. So it can't be an investment corporation. It has to be doing some form of active business. And that business cannot be a professional services business. So it can't be accounting, law, medicine, architecture, these sorts of things. The owner must have held the stock for at least 5 years. So I shouldn't say at least, more than 5 years, so greater than 5 years. And the amount that you can exclude, so the gain amount that you can exclude is limited. It's limited to the greater of 10 million or 10 times that person's adjusted basis in the stock. There is also rollover provisions that permit deferral if you reinvest the proceeds in a new small business stock. Okay, so as I said, it's an exclusion, and the amount you can exclude depends on the timing of the small stock acquisition. So you can see, depending on different acquisition dates, you would exclude either 50%, 75%, or 100% of the gain on the sale of that small stock. So the tax rate that applied before the exclusion is 28%, or your marginal rate if it's lower. So what that meant in the old days is if you were in the 37% bracket and you received a 50% exclusion, the tax rate is 14%. So it's not half of 37. It's also not half of 20 or 15. It's half of 28. All right, that brings us to the end of chapter 4, right? That was a quick video. I hope that wasn't too painful because I know part 1 was kind of long. Thanks for watching.